I was thinking about this. Stepping into the cockpit of a commercial airliner for the very first time has to be one of the most visually overwhelming experiences imaginable.
Oh, absolutely. Just pure sensory overload.
Right. You're immediately confronted with this absolute wall of information, just hundreds of blinking lights, switches, dials, uh, digital screens, and they're all flashing. They're all competing for your attention at the exact same time.
Yeah, and if you don't know what you're looking at, it just looks like pure chaos.
Exactly. Which, I think is exactly what happens to most of us when we open up a brokerage app or turn on a financial news network.
It's the exact same feeling because your brain just can't prioritize all those inputs. The financial media complex is inherently designed to throw, a million data points at you every single minute.
Yeah, it really is.
It literally profits off of your urgency and your anxiety.
Right, but think about a trained pilot. They aren't actually looking at 300 individual dials all at once.
No, of course not.
They're looking at a dashboard. They check, 3 or 4 specific instruments that tell them everything they need to know about the health of the aircraft, the trajectory, the weather outside.
And that is exactly what we are building for you today.
Welcome to this deep dive. We know you're looking for a way to track the stock market, to filter out all that noise and extract the actual underlying signals without drowning in a sea of ticker symbols.
It's a really crucial shift in mindset. Because successful investing, it isn't about knowing everything that's happening everywhere all at once.
Right, that's impossible.
Exactly. It's simply about knowing exactly what to watch, understanding the mechanics of how those data points interact, and knowing why they actually matter to your specific portfolio.
So let's start building this dashboard, because I think the most counterintuitive part about tracking your investments on the Indian stock market is that your daily routine doesn't actually start by looking at India.
No, it doesn't.
Before you even think about domestic stocks, you have to look across the globe. You have to read the time zones.
Right, because markets act like this continuous series of falling dominoes across the globe. Liquidity flows from one time zone to the next. So what happens in one hemisphere inevitably crashes into the next one.
Right.
You simply cannot view the domestic market as an isolated island. It just doesn't work that way.
Which brings us to what I like to call the overnight weather report.
I like that.
Right. If you want to know what's going to happen on a Tuesday morning, you actually need to track the major U.S. indices, specifically the Dow Jones and the NASDAQ, on Monday night.
Yeah, Monday night is key.
But the most precise instrument for an Indian investor here is tracking ADRs, right? The American Depository Receipts.
Yeah.
Let's talk about how this arbitrage actually works.
Sure. So take a heavyweight company like Infosys.
Okay.
In India, you trade it under the ticker INFY. But that exact same underlying equity is simultaneously listed in the U.S. market as INFY ADR.
And you see the same dual listing mechanism with powerhouses like SBI and HDFC too, right?
Exactly. And the time delay is the entire advantage here. Because the U.S. market is heavily trading while India is literally asleep.
Right.
Those ADRs are actively absorbing global macroeconomic shocks in real time. So if it's Monday night in Mumbai, Wall Street is open, and institutional money is actively pricing in new information on Infosys.
It's literally Doppler radar for your portfolio.
Yeah, that's a great way to put it.
If you check your screen before bed and you see that INFY ADR is just aggressively selling off in New York, you have a highly probable indicator that INFY is going to face downward pressure the second the India markets open on Tuesday morning.
You aren't guessing, you are just watching the storm front roll in.
Exactly. And you can refine that prediction even further right before the domestic market opens, right? With the SGX Nifty.
You're right, the SGX Nifty. It operates as a really critical futures derivative. Because it trades in Singapore, it prices in all those overnight global developments before the 9:15 a.m. bell even rings in Mumbai.
So by checking the SGX Nifty, you already know whether the broader market is preparing for a gap up, opening significantly higher due to overnight momentum or a gap down.
Right, you step into the trading day already anticipating the opening trajectory. You're not caught off guard.
Okay, so we have our overnight radar and we have our pre-market futures check. The 9:15 bell rings, the market is moving, and you might think the global influence is over for the day.
But it's definitely not.
No.
Yeah.
Because there is this massive midday jolt that catches so many investors off guard. Right around 1:30 p.m. Indian Standard Time, the European markets start to come online.
This is a massive overlapping liquidity window. London and Frankfurt open their doors, and suddenly this huge wave of European institutional cash starts flowing.
I've watched this happen in the charts so many times. Like a stock will be perfectly stable, just consolidating normally from 9:00 a.m. until noon.
Yeah.
And then right around 12:30 or 1:30 p.m., it suddenly spikes aggressively, or conversely, the bottom just falls out of the chart entirely.
And if you aren't aware of the time zones, a sudden 1:30 p.m. drop is terrifying.
Oh, absolutely. You instinctively want to hit the sell button because you assume the company itself just announced terrible news.
Right. But context entirely changes your reaction here. When you know that European markets just opened with a surge of negative global sentiment, you recognize that the drop is just a macroeconomic ripple effect.
It's not about the specific company.
Exactly. The broader global mood shifted, and the algorithms trading in the Indian market are just reacting in real time. It turns what feels like a scary, unexplained drop into a highly predictable market mechanic.
So you don't panic sell.
No, you just ride out the volatility.
Okay, so we've got the global timeline locked in. The overnight ADRs, the morning SGX futures, the 1:30 p.m. European overlap. But a timeline only matters because of who is actually moving the money during those specific hours, right?
Right, exactly.
This means our dashboard needs to track the underlying currents of the market. We need to look at the daily heavyweight battle between the FIIs and the DIIs.
Yes. Tracking the daily net data for FIIs, which are foreign institutional investors, and DIIs, domestic institutional investors, is arguably the most reliable sentiment gauge available to you.
And the DIIs, these are the massive domestic entities, right? Like the Life Insurance Corporation of India, LIC, or the major domestic mutual fund companies.
Yeah, and they provide the structural floor for the market. They are pooling staggering amounts of domestic retail capital.
And then on the other side of the trade, you have the FIIs bringing in aggressive foreign capital.
Right.
And the reason we care about their daily net buying or selling figures isn't just trivia. I mean, it literally dictates the momentum of the trading day.
Oh, absolutely. The overall trend entirely depends on who is winning that daily tug of war.
Right, like if the FIIs are dumping equities and the DIIs aren't absorbing the supply, the market bleeds.
Exactly. They are the market movers. They dictate the flow of liquidity.
But, okay, let me push back on this a bit on behalf of our listeners, because it can feel incredibly defeating to look at this data. If these massive FII and DII whales are moving millions of shares through these automated block deals, and their daily clash completely dictates the direction of the market, what is the point of the retail investor? I mean, are we just tiny fish completely at the mercy of wherever the whales decide to swim?
It's a really valid frustration, but you have to reframe how you use the data. You don't put FII and DII net figures on your dashboard to compete with the institutions.
Right.
You use them to map the ocean currents. When you track the daily net sentiment, you understand the direction of the underlying tide. The goal of retail investing isn't to fight the tide.
It's to ride it.
Exactly. It's to recognize the institutional momentum early so you can align your positions with it. You use their massive liquidity to carry your trades forward rather than getting exhausted trying to swim upstream against $1 billion sell-off.
That makes perfect sense. We are mapping the currents to draft off their momentum.
Yeah.
But here's the fascinating part to me. Those FII whales don't just wake up and randomly decide to buy or sell Indian equities.
No, they definitely don't.
Their massive cash flows are entirely dictated by the shifting prices of global physical assets. The institutional tide is basically a reaction to this macroeconomic seesaw.
And this is where the interconnectedness of the global economy becomes highly tangible. If you want to anticipate institutional money flow, you have to track the major commodities and currencies.
Right.
Specifically, you need to watch the US dollar, gold, and Brent crude oil.
Let's start with the dollar, because the mechanics here directly impact corporate bottom lines. Take a scenario where the dollar is sitting at, say, 83.6 rupees.
Okay.
If the value of the dollar suddenly surges against the rupee, we see the seesaw effect immediately, don't we? One sector's absolute disaster becomes another sector's margin expansion.
The translation effect is massive. So if the dollar strengthens, Indian companies that generate their revenue in foreign currencies...
Like the IT sector, right?
Right. Specifically the massive IT services sector and major pharma exporters. They suddenly see a huge spike in profitability. Their contracts are paid in stronger dollars, but their massive operational and payroll costs are still in rupees.
Wow, so that entire currency difference just drops straight to their bottom line as pure profit.
Exactly. They didn't sell a single extra software license, but they're suddenly making significantly more money.
But then on the other side of the seesaw, look at domestic manufacturing companies that rely heavily on importing raw materials from abroad.
Right, it's the exact opposite.
A stronger dollar means they are suddenly bleeding cash because they have to spend significantly more rupees just to acquire the exact same baseline materials. Their operating margins get crushed overnight.
And you see the exact same dynamic with gold. When global gold prices surge, you have to immediately think about the sector divergence.
Like jewelry companies.
Yes, jewelry companies take a severe hit. Their core raw material just became prohibitively expensive, which suppresses consumer demand and eats into their margins.
But flip the seesaw, and a rising gold price is an absolute gold mine pun intended for gold finance companies like Muthoot Finance.
That's a perfect example. When the underlying price of gold goes up, the value of the physical collateral they hold against their entire loan book automatically increases.
Which means their balance sheet gets safer and significantly more profitable overnight, and they didn't even have to originate a single new loan.
Exactly. And then you have Brent crude oil, which operates as the base cost multiplier for the entire global supply chain.
Oh, crude is huge.
When crude prices shoot up, it isn't just about pain at the gas pump. Industries that rely on petroleum derivatives as a base raw material get completely squeezed.
Right, the classic example is the chemicals and paint sector.
Yeah.
If you're producing paint, expensive crude oil translates directly to an expensive production cycle. So as an investor, tracking this seesaw totally shifts how you consume the news.
It really does.
When a headline flashes that Brent crude is spiking, you shouldn't just passively absorb it as global news. It needs to trigger an automatic mental map. You should instantly think, okay, oil is up, which means the paint sector's margins are compressing, which means institutional algorithms are going to start rotating out of paint stocks.
Right. You are directly connecting the macroeconomic trigger to the microeconomic outcome.
Which naturally brings us to the micro level. We've mapped the massive global trends, the currencies, the commodities, the institutional tides, but individual companies can completely override those macro trends with their own specific corporate actions.
Oh, definitely. The market mechanics change entirely when you zoom in on stock-specific news.
Because the market absolutely hates uncertainty, and it severely punishes bad debt.
Yes, it does.
If a story breaks in the Business Standard or the Economic Times that a major corporate entity has defaulted on a massive loan facility from, say, SBI, you don't need to look at the global price of oil to know what happens next.
No, the macroeconomic data is temporarily irrelevant. That specific default acts as a massive localized weight, and SBI's stock price is highly likely to take a severe hit the next morning.
But corporate actions aren't always negative shocks, right? The most powerful positive signal management can send to the market is the share buyback.
Oh, buybacks are huge. It's a calculated corporate maneuver that artificially reprices the stock.
Let's walk through the actual math of a buyback because the arbitrage opportunity here is fascinating to me. Suppose a company is currently trading on the open market at 1,500 rupees.
Okay.
The management team suddenly announces a formal buyback program, stating they will use the company's own cash reserves to buy back shares at 1,650.
Right.
Historically, the moment that is announced, the open market price rapidly climbs up from 1,500 toward that some 1,650 mark.
Right, because it creates an irresistible opportunistic advantage. Management is explicitly signaling that they believe the stock is deeply undervalued at 1,500.
Right.
And they are putting their own capital on the line to prove it. Furthermore, by buying back and retiring those shares, they are permanently reducing the total outstanding share count.
Which mechanically boosts the earnings per share for everyone else left holding the stock.
Wait, so does it act almost like an artificial gravity pulling it up, or is it just a confidence signal? I mean, if the stock is hovering at 1,500, but the company legally guarantees they'll pay 1,650 for a certain allocation, arbitrage traders and institutions are going to flood in to close that 150 rupee gap, right?
Exactly. You aren't just guessing about market sentiment anymore. You are watching the market react to a guaranteed premium offered by the corporation itself.
Makes sense.
It creates a highly predictable price action based on hard mathematics rather than just pure speculation.
Okay, so if we step back and look at the dashboard we've built, we have the instruments fully calibrated. We're reading the ADR weather reports, tracking the SGX Nifty, and anticipating the European overlap.
Right. We are mapping the FII and DII liquidity currents. We're mentally connecting the dollar, gold, and crude seesaw to specific sectors. And we are watching the financial papers for microshocks and buyback arbitrage.
The analytical framework is complete, but the final and arguably most critical piece is execution.
Ah, yes.
Because having all this data is useless if you don't know the most efficient vehicles for actually deploying your capital.
And the data on execution is actually quite counterintuitive, particularly regarding fees.
It really is.
Because the conventional wisdom is always that beginners should just park their money in massive, actively managed large cap mutual funds and forget about it. But the numbers tell a very different story.
It's a simple but brutal mathematical reality regarding commission drag. Actively managed large cap mutual funds typically yield somewhat modest returns over the long run, often hovering around the 12 to 15% mark.
Okay.
However, to get that return, you are paying a fund manager an active commission fee that can run up to 0.8% annually.
And 0.8% might sound like a tiny fraction, but when you compound that fee over 10 or 20 years, it absolutely devours a massive portion of your total wealth accumulation.
Exactly.
You're paying a premium fee for someone to pick massive, inherently stable companies that you could easily identify yourself. If you want large cap exposure, it's significantly more efficient to bypass the fund manager, avoid that 0.8% fee drag, and simply accumulate fundamentally strong large cap equities directly when the market gives you an opportunistic dip.
But if you want broader, diversified exposure to specific sectors, say you're highly bullish on the structural growth of Indian IT, banking, pharma, or auto and Asian, the math heavily favors sectoral index funds.
Because index funds completely remove the highly paid fund manager from the equation, right?
Right. A Nifty IT or Nifty Bank index fund isn't actively making discretionary trades. It's just algorithmically tracking the sector.
So because the human element is removed, the management margins are practically non-existent.
Exactly. You pay incredibly low commissions, often just 0.1 to 0.2%.
Wow.
Which gives you the exact same broad exposure without sacrificing your compounding interest to management fees.
Now, where this strategy completely flips is when we look at the small cap sector. If you are looking to take on higher risk for aggressive growth, direct stock picking becomes incredibly dangerous.
It really does.
And this is the contradiction that I find so fascinating. The math tells us to completely avoid mutual funds for safe, massive, large cap companies. But then it tells us we absolutely must use mutual funds for highly risky, volatile small cap companies,
Yeah.
and that we should strictly avoid direct small cap or penny stock picking. Let's break down the risk asymmetry there because it feels completely backwards at first glance.
It comes down to the sheer difficulty of information analysis. Large cap companies are heavily scrutinized. They have massive institutional coverage, highly transparent quarterly earnings, and structural stability.
Right, you don't need a fund manager to tell you that Reliance is a stable entity.
Exactly. Small cap stocks, however, operate in the shadows. They are highly volatile, illiquid, and incredibly difficult to accurately audit. A small cap can double in a month based on a single contract, or it can go entirely bankrupt due to a minor supply chain disruption.
So the variance is just too high for an individual to manage without full-time dedication.
Precisely. Navigating that level of volatility requires deep forensic accounting, management interviews, constant monitoring. That is precisely when you want to pay the 0.8% fee.
Ah, I see.
You use a small cap mutual fund to buy a manager's expertise and their safety net. You pay the fee to mitigate the extreme variance, at least until you reach a level of highly advanced expertise where you can comfortably audit small cap balance sheets yourself.
That makes perfect sense. You only pay the premium fee when the asset class actually requires premium expertise.
Exactly.
Now, no dashboard is complete without the structural foundation. Beyond the active trading in sector funds, you have to anchor the portfolio with long-term tax-efficient instruments.
And for Indian investors, the two most powerful structural anchors are the NPS and the PPF.
Right.
The National Pension Scheme, specifically utilizing the Tier 1 and Tier 2 account structures, allows you to compound wealth over decades using index funds with absurdly low commission structures, often around 0.1%.
And then the PPF, the Public Provident Fund, it operates as the ultimate volatility shield. Right?
It really does.
It currently offers a guaranteed 7.1% interest rate.
Yeah.
And yeah, it requires a 15-year lock-in period, which forces extreme discipline. But the structural benefits are unmatched
Oh, absolutely.
because the accumulated wealth is completely tax-free at maturity. And you capture the immediate benefit of claiming it as a tax deduction under Section 80C every single year you contribute. It's the ultimate set-it-and-forget-it wealth engine that just quietly grinds away in the background while you focus on your active equity positions.
And it provides the psychological baseline. When the equities market is bleeding, knowing your PPF is guaranteed keeps you from panic selling your other assets.
So look at the dashboard we've constructed. The chaos of the cockpit is gone. We know exactly which dials matter. We start the night before, utilizing the US ADRs to anticipate the weather. We check the SGX futures before the morning bell. We mentally prepare for the algorithmic volatility of the 1:30 p.m. European Open.
We use the massive FII and DII liquidity flows to map the market currents, ensuring we're swimming with the institutional tide rather than against it.
Right. We track the macroeconomic seesaw, instantly translating shifts in the dollar, gold, and Brent crude into margin compressions or expansions for specific sectors. We watch the financial wires for localized gravity events, like corporate loan defaults or the massive magnetic floor of a share buyback.
And we execute with absolute mathematical efficiency. We avoid the fee drag on large caps, utilize ultra-cheap index funds for sector exposure, happily pay the premium for small-cap risk management, and anchor the entire operation with a tax-free compounding of the PPF and NPS.
You no longer need to know every single piece of financial data flying across the ticker tape. You just need to read the mechanics.
Though, looking at the entire interconnected machine, it does leave me with one final, slightly unsettling thought.
Oh, what's that?
Well, we built this entire timeline, the overnight ADRs, the 1:30 p.m. European overlap, based on the physical reality that human beings sleep and work in different time zones, right?
Right.
We are capitalizing on the delay of information traveling across human geography.
It's the ultimate arbitrage of time.
Exactly. But as algorithmic trading becomes infinitely faster, heavily utilizing AI to parse global data instantaneously without human input, the concept of sleeping markets is disappearing.
Oh, wow.
How long until the machines entirely close those predictable human time zone gaps? And when that geographic delay is completely eliminated, what will be the next predictive edge for the everyday investor?
Now that is a terrifying and fascinating thought to end on. The game is always evolving. But until next time, keep your eyes on the dashboard.